it's a significant change in the macro regime. And I am a believer that that's the case. It's that we're starting an inflationary era. And when I say inflationary era, it doesn't mean necessarily that inflation will always be on the rise. It just means that it will be higher than historical standards, regardless if it is 3-4% throughout the next 10 years in average. And I think that will be the case because the underlying factors that we have right now are very entrenched in the economy. The chronic underinvestments in natural resources, the deglobalization trends are continuing to be very significant. And you have the fiscal stimulus still very inflationary, and the inequality issues kind of creating this need for workers to demand higher wages and salaries when social programs are also going to be a large part of this too. So there are all these things, and I think if you think about the debates happening in markets right now, is that some folks believe that this upper move in inflation and the downward move that we've seen recently is just sort of a cyclical kind of change that was not as fundamental as or structural as some macro thinkers believe. And I'm in the camp that these changes are very structural in their nature, and that is the reason why we're seeing some different behaviors in asset classes. And again, it's not doom and gloom or anything like that, but it will create different types of opportunities.
On this episode of the What the Finance podcast, I have the pleasure of welcoming back Tavi Costa, who's a partner and macro strategist at Crescat Capital. So, Tavi, thanks so much for coming back on the podcast.
Thanks for having me, Anthony.
No problem. And I'm looking forward to it because I think it's been over a year since we last spoke, and a lot has definitely happened. But to be fair, if you look at the markets, I guess there hasn't been much movement, but lots of noise during that period. So, if we can get maybe your what you're currently seeing in the markets and I guess in the economy and the key things that you're watching at the moment.
Well, I think 2023 has been quite a surprise to a lot of people, and a good lesson that most of the times what is obvious is obviously wrong. And a lot of people are very bearish, including even ourselves, or myself, at least, in terms of the overall economy. And we've had a very critical move in equity markets. The economy could be already in a recession, who knows? Although there are mixed signals in terms of that. However, there have been some pivotal changes in terms of macro regime over the last 2 to 3 years that I think a lot of people are sort of ignoring, unfortunately, still. And that has to do with, the 60-40 portfolios and the fact of the value to growth change and interest rates being higher than historical norms. Inflation, although decelerated, still is higher than also historical norms. Cost of living is still higher than historical norms. Wage pressure is starting to become more and more evident. Protests going on in terms of folks demanding higher paying. And so all those things are happening. The fixed income market is still under pressure, despite the fact that we've had technology and other ultra high long duration assets doing very well. Gold is starting to look less volatile, especially on the downside relative to US Treasuries for the first time in the last 45 years. And so there are a lot of big changes. Those 60-40 portfolios had a very difficult year in 2022. Those are usually the beginning of big changes ahead, and a lot of people, again, are dismissing or neglecting some of those shifts. And so we're kind of in the middle of all this. We've had Brazil and other emerging markets that are more commodity favorable actually perform quite well, despite the notion that if the Fed is doing its steepest rate hike cycle in almost in decades, you would expect that those markets would be under pressure, but we didn't see that. So there's so many different ways of analyzing it. I think we're still in the process of seeing a lot of those macro trends unfolding. I'm very bearish in parts of the markets that are very crowded, such as the big tech. And I think there are companies that will be rolling their debt at a much higher rate, that will be squeezing their margins also because of the wages and salaries, and potentially consumer getting in trouble. So there's opportunities on that side. You have credit spreads and other parts of the market still being very tight, which is a sign of sort of, not in line with the risk, meaning volatility should be a lot higher given where rates are. And we're seeing a lot of those instruments that sort of help you to understand volatility are still historically suppressed, regardless if it is VIX or credit spreads themselves. And credit spreads to me look like an opportunity on the short side. And the commodities market continues to be more and more attractive. I think, we put out a letter recently about this redefining moment that we are in 60-40 portfolios and conventional and traditional ways of investment strategies and allocations. And I think that those hard assets, particularly commodities, will start, becoming a significant part of those portfolios. And so how will that dynamic really fulfill this? Industries that have been, so out of favor over the last decades are all going to be important trends. So sorry to go long, but those are the thoughts that I have about overall markets right now.
Yeah, it's interesting. I guess maybe can we focus on that shift that you've seen over the past few years? I know you've sort of mentioned a few, I guess, the impacts that shift has had, but can you maybe focus more about that, and what is this shift, not just on assets, but I guess the global economy and the impact it will have?
Well, I think there's so many charts where you see those breaks of correlations or divergences in lines, or either macro assets or indicators, where there's a very long list of indicators basically pointing to a recession, and then there are important changes in terms of how assets have behaved in times when, let's say, treasuries have been under pressure. You would expect that to reflect in the gold market, but gold market has been incredibly resilient, especially relative to real rates. And it's either because we're yet to see the gold market reflect much lower prices, or it's a significant change in the macro regime. And I am a believer that that's the case. It's that we're starting an inflationary era. And when I say inflationary era, it doesn't mean necessarily that inflation will always be on the rise. It just means that it will be higher than historical standards, regardless if it is 3-4% throughout the next 10 years in average. And I think that will be the case because the underlying factors that we have right now are very entrenched in the economy. The chronic underinvestments in natural resources, the deglobalization trends are continuing to be very significant. And you have the fiscal stimulus still very inflationary, and the inequality issues kind of creating this need for workers to demand higher wages and salaries when social programs are also going to be a large part of this too. So there are all these things, and I think some, if you think about the debates happening in markets right now, is that some folks believe that this upper move in inflation and the downward move that we've seen recently is just sort of a cyclical kind of change that was not as fundamental as or structural as some macro thinkers believe. And I'm in the camp that these changes are very structural in their nature, and that is the reason why we're seeing some different behaviors in asset classes. And again, it's not doom and gloom or anything like that, but it will create different types of opportunities, and it will also change the leadership of the market. And so this idea that we've had recently of tech stocks really leading the market, I am very skeptical about that, because I think, number one, it's a crowded trade. Number two, if that is the case, that we're going to see what I think we're going to see, then higher cost of capital will actually have to reflect that the present value of those businesses needs to be lower. So that is, and why pay 100 times earnings on a FANG stock or a technology business when you can buy a company in Brazil or other emerging markets that have that kind of, favorable commodity-led or resource-rich economy that are trading at 3-4 times earnings on very well-established businesses over decades. And so banks being one example, or other commodity parts of those industries. And I think that that's all sort of the kind of risk versus opportunity that we're seeing. And markets will always be like that, but I think a lot of people are dismissing some big changes here that will likely shift the way we may create some real wealth generation over the next decade or so, really being driven by focusing on value investing and natural resource industries and hard assets, and being more careful with how we value companies in a world where cost of capital could be higher, and we may see deglobalization playing a role and some other issues that may create higher risk over time.
Yeah, and I guess if we look at the treasury markets at the moment, it's inverted yield curve. So I guess they probably are disagreeing in the short term of they're expecting interest rates to go down from here, I guess over in the next few years. So do you think that's something that people are underestimating this macro shift, that they just think maybe we're going to see a recession, interest rates are going to go down, inflation is going to come down, and then we're going to go back to the traditional way of doing things?
Well, that's a good point. So, the traditional way of doing things is you have, a recession every 5 years or so, give it or take. Every time there's a recession, what you do is you increase your allocation on fixed income, and there is a period where inflation rises right before the crisis, then inflation starts to decelerate, and then there is an economic shock. The Fed has to cut interest rates. Treasuries on the long end actually move a lot higher. And that sort of framework has worked so well in the last 2 to 3 kind of decades, but I don't think they're going to work as well. And you buy the dollar and so forth. I think that during more stagflationary periods, gold is actually served very well as a defensive asset. And I'm more and more of a believer that that's going to be the case, and that's because eventually the market begins to price in that if there is any sort of shock in the economy, ultimately what we see is very, very large amounts of stimulative packages from the government and from the Fed that it eventually drives hard assets a lot higher. So that to me is a risk. So the market is seeing that and thinking, oh well, that's also positive for the overall stock market, because essentially what we see is a flood of liquidity coming in that eventually drives everything higher. But ultimately what you find is that, those periods when you have this level of intervention from the monetary and fiscal side, and also because of the inflationary era that we're likely getting into, it eventually drives cost of capital much higher, which is already happening, right? I mean, if you look at the junk bond yields, if you're a company, a corporation is having to raise capital at a 10% or so rate. And so if that's the case, over time, if we start seeing more and more of those rates staying higher for the overall economy, not just one segment of the market, which is the junk bonds, you're going to start seeing some issues here, because some business models are not really, I guess, appropriate for a macro regime like that. And so, if you start applying some thoughts, if you look at some companies that have worked so well over the last 10 years or so, whatever are the companies at Lyft and Uber and some others. And I guess Lyft is not, Lyft and Uber are certainly in that camp, but some other software businesses and so forth have really been driven by this kind of growth mentality and not so much focusing on profitability. with those businesses, a good exercise would be to think about if those businesses would survive in a period like the 70s or the 1940s or the 1910s, when we had inflation and investors are demanding higher yields and therefore higher cost of capital was the case. And would those businesses survive during those decades? And the answer is not necessarily those ones, but some of those companies would not survive. And so if you read the book on, I forgot the name, I think it's a Shoe Dog or something, on Nike, they tell you that Phil Knight tells you that during that period it was very difficult. Nike almost didn't survive because of the amount of debt that they had to take and how costly that was for them. And that's one of the most successful businesses we had over their last decades or so. And so it was very difficult to really sustain those periods of times. And I think we're kind of in the beginning of one of those again. Now, you think what's happening with the treasury market right now, with the amount of issuances that we're seeing and how much we're going to see of the rolling of the debt dynamic over the next 2 to 3 years, which is about 45% of the overall debt. And knowing that 12 months ago, that debt itself was near 0% in terms of the interest rates that the government had to pay. And, the next 2 to 3 years, they're going to be rolling their debt at least, if it's in the short term, close to 5% rates. How would that impact not only the interest payment issue, but really by driving interest rates even further to the upside, given the amount of issuances relative to the demand side? So, I don't think a lot of people are considering those big changes. This was not the case in 08, right? In 08, what we had was central banks outside of the US were very focused in increasing their balance sheets by buying US treasuries, and we're not seeing that level of demand today. Banks are big buyers of treasuries at those times. We've had other foreign institutions being big buyers, and we're not seeing that. And the treasury market's sort of this kind of in the cornerstone of the financial system, because if you have lack of liquidity and volume for those instruments, what does it mean to junk bonds and corporate bonds and the overall market that tends to price everything on a risk-free rate that is priced on the treasury side? So, a lot of things are kind of being dismissed, in my opinion, if we're entering a world where rates are pressured higher than we've seen in the last 20, 30 years. And so, and it's sort of a no-brainer when you think about why are so many allocators completely ignoring hard assets when there's so many clear signs that it's becoming increasingly evident that inflation is here to stay. And, to me, and when somebody says, no, I don't think people are forget, well, just look at traditional 60-40 portfolios. How much of them actually hold commodities or gold or oil or copper or nickel? Think about the size of those markets relative to the size of the technology space, for instance. There's some big divergences there that I don't think are going to be the case 10 years from now.
Yeah, I guess you could say recency bias, and the allocators who have maybe gone for the more value stocks have not been rewarded in the last 10 years. So maybe there's this focus of just following the market, continuing to do what's worked previously. And yeah, at one point in time, they'll be caught out.
Yeah, and you can see that, I've put out a letter recently that looks at the valuation of those traditional portfolios. And I just calculated all the way back to the 1800s, what supposedly is that history of valuations of 60-40s, applying the 60% weight on equities and 40% weight on the fixed income side of those portfolios. And what you find is that in August of 2021, we've had the most expensive period for those portfolios that we've seen in 130 years. And, there are clear patterns of ups and downs that tends to be secular moves in terms of periods that you want to put your capital towards 60% in equity and 40% in fixed income. And times you just don't want to do that because the yields provided by those two instruments are so low that the risk of deploying capital into those two asset classes are just not worthwhile. And so right now, throughout history, we are in that period where that calculation itself is, extremely expensive right now. And I'm not sure in the next 10 years, those two instruments are going to provide the returns that most investors are expecting, especially at a time when this newer generation has a unrealistic level of expectation when it comes to returns. This maybe it has to do with crypto and technology and the fact that we haven't seen a sustainable shock in markets where everything comes back. It comes down and it comes screaming back, and it's been easy. I put in quotes because it's never easy, but it's been somewhat of repeatable. And so markets go down, and those younger folks that have not necessarily bought those assets, but really seen those markets come back, have this degree of confidence that it's always going to be the case. And I worry about those things, because I don't think it's going to be like that. I think equity markets have already seen most of their exceptional performance for the decade potentially. And if that's the case, and just looking at how inflated valuations are and how we tend to see a compression of multiples, particularly during inflationary periods, and how we don't often see 2 straight decades of robust growth in corporate earnings, and the fact that the prior decade was by far the best growth in corporate earnings in real terms that we've had in history, and that the other 2 times that we saw that was in the roaring 20s and the 90s, which actually basically preceded a very difficult decade, which was the 30s, Great Depression, and the 2000s and 2008, which was also a difficult period with the tech bust and the global financial crisis. So, I think it will likely be the case here again, where we're going to see a struggling process of a lot of corporations and figure out that AI is a lot more costly than people thought, and to make money in those trends are going to be harder. That we're living in a world where you should emphasize profitability, that the cost of debt itself is going to be more expensive. The access for capital is going to be more difficult because the Fed has to keep rates higher. And all that, it's something that is really not priced in financial assets overall. So, and at the same time, there's a desperate need for things such as construction. Housing market's too expensive, so you may see a construction boom in residential markets. Reshoring is a big topic, so infrastructure developments are going to happen in developed economies, and that comes full circle into commodities again, right? Because in order to build those things, what we need is then commodities, hard assets, and that's also not priced in markets at all, at a time when commodity to equity ratio is at a 50-year low. So to me, that seems, much more attractive from a risk reward perspective than owning a 60-40 portfolio with one of the most expensive valuations in the history of that portfolio itself.
So if we say the 60-40 portfolio isn't going to perform as well in the next decade or so, what alternatives would you think are going to maybe provide that performance, or even not that, but just better performance than that portfolio?
I think there's a lot of buckets that will do much better than those 60-40 portfolios. What I would be doing with my money is, I think the metals and mining industry is still very unloved, historically speaking. It's one of the oldest industries in history. However, it seems to be completely dislocated and with a lot of inefficiencies that are likely to create a lot of opportunities. If I'm thinking about that 60% of equities in my portfolio, I would certainly consider commodity-led economies and commodity-led businesses be part of that percentage. Regardless if it is Brazilian equities would be a big portion of that. I think those are going to outperform US markets. I think South America could be a great way to invest, given its large exposure to resources. I think the oil market will do well. I think home builders could do well because we're going to need more homes. And on the other side of that 40%, the idea of the 40% is to look for an asset that is not correlated to that 60%, that provides a haven aspect during downside periods of the market. And I think gold is going to be a very important, or play a critical role into becoming that asset over time. So if that's the case, you're kind of seeing two forces at once in the gold market. One is central banks buying gold for other reasons, not because they're worried about downside. They're worried about owning a neutral asset and improving and enhancing the quality of their international reserves. So they are buying gold for other reasons. And then you have 60-40 portfolios that are now ignoring the metal, but will likely be buying that when they realize, first of all, the changing market correlations, and number two, the fact that gold itself may be the safest alternative relative to US Treasuries. And as we see that evolving, it's going to drive the demand for gold, and gold will likely get into what I think would be a secular move. A secular move in gold to the upside tends to drive other commodities. And so I get very bullish in all this because I think those businesses that hold resources in metals and so forth are just not priced accordingly. And so those things are probably going to be the ones that will perform the best. I mean, I can speak for my portfolio, and we've done very well just by doing that, and not necessarily buying GDX and all the kind of more traditional ETFs inside of the metals and mining space, but rather looking for kind of a way to apply an activist role into companies that we thought were inefficiently mispriced. And there are no shortage of those things because right now everything is priced for failure. So you have a very high quality asset priced the same way as a poorly driven asset. And so you can take a long-term mentality and mindset of creating a strategy of really accumulating those high quality companies over time and creating a lot of value. So, to me, that's a much more attractive way of investing than conventionally just buying technology companies and other things that have done so well that people think and assume are going to do, continue to do that well over the next 5 to 10 years. And whatever worked in the last 5 years is unlikely to work in the next 5 years. And that applies to a decade long as well. And so you have to kind of have that mentality rather than, looking at the backward looking kind of analysis is very concerning. And so it's important to have that way of understanding that macro and correlations change over time, and you have to kind of apply that in your portfolio as you navigate this the next 5 to 10 years. So yeah, I caution a lot of people to be looking backwards and at least consider resource industries as an opportunity, because I think that's where the biggest returns are going to come from.
Yeah, and I know there's quite a lot of nuance to look at as well when you look at the resource industry and the companies in particular. So I don't know if there's anything in particular that you watch yourself when researching those companies compared to like regular companies. Yeah.
Yeah, I mean, no, I mean, just think about the fact that there are not enough geologists in the world today, and how does that apply into the fact that people don't know how to analyze those stocks and those projects. It makes so much sense when you look at the world with those lenses of the fact that we have, just a lack of that expertise worldwide. Then what does that mean about, how investors are approaching this industry? And so creating partnerships with people that have been in this space for a very long time is probably the smartest thing somebody can do. Or, someone who is an expert of the Brazilian equity market. I mean, will be a very skillful thing to do in the next 5 to 10 years. Folks that understand value investing very well, that go to earning calls and really dive into those numbers and 10Ks and so forth. Those guys are going to be incredibly useful in this next, macro regime that we might be entering. And so I think that those things are unfortunately, still, I think Peter Thiel has a thesis about, the MBA idea, where, when you go to the most popular MBA courses are usually the ones you should be fading, regardless if it is software engineering or programming and so forth. I mean, how many people do you know that are really looking forward to become a geologist, right? I mean, it's so reflective of those imbalances in markets right now. So going back to your question, how to look at it, I've been very busy trying to understand that market, and I certainly have a lot of opinions. I think in the resource space where I deal with, which is kind of early stage companies, is almost taking a hybrid venture capital approach of, rather than investing in technology startups, doing that in metals and mining. So startups of metals and mining that currently have a property that is in a jurisdiction that we believe can develop projects. Number two, are onto what we think will be world-class discoveries, but we don't need to be necessarily writing every company we invest money, knowing that the fact that everything is priced for failure allows you to have a very diversified book of companies that ultimately a few of them may work out very well and become unicorns. And we've had that happen in our funds. And that's the beauty of this market right now, is everything is so cheap that you're able to diversify. But however, if you don't understand the market, there's about over 2,000 public companies in the mining space, in which 90% of them are probably not worth what they're worth in the market right now, even though they're depressed. So you have to be careful. But there's some really good opportunities right now. And if you find that kind of 10% of that market, and you kind of screen out most of the things that are crap, which I think for any geologist, there are, many ways to screen out and improve your probability very quickly of what is good and what is bad in this industries, from a technical perspective of geology overall of those projects, that can improve your betting odds dramatically. And that's sort of what we've been doing. And then you can add on top of it, being able to infuse technical expertise into those companies through our network of geologists themselves that can perhaps become or create that trigger for those businesses to improve over time. It's something that the markets are also not really, necessarily considering that it's already happening in some parts of the industry, and it's certainly something we've been doing. And lastly, I would say what I like about this industry is the optionality. You have the fact that you can buy things cheap. Number two, you can diversify because everything is cheap. Number three, you can add value by bringing in an expertise or someone who is a true, expert of that particular project, and can really help that company to grow. Okay, that's another thing. Number 4 or 5, you have also the fact that there is a desperate need for metals. So at some point, institutional capital is going to be, or it's going to be funnel into this industry, and so looking for the best assets in this space is smart, and probably it's still an early move in my opinion. And then on top of it all, you have the chance of entering a gold cycle because of how indebted the economy is and how you have all this multi-factor approach that can drive gold prices a lot higher. And therefore, I've never seen a gold cycle that didn't drive commodity cycle. And that macro tailwind itself can be, alone what can get you those extreme returns in this industry over time. One time I had a chance to pitch our idea to Sam Zell, who died recently, unfortunately. And, it's a huge pleasure to be able to speak with him first, because I'm a big fan. I used to be a big fan. And when I pitched to him what we were doing, he was not only impressed, but he said, I think, congrats for being early in these trends. I think that's the right approach. And so, I'm very excited about being alone in this sort of idea, because I think that's where when you invest in the markets, you don't invest when most people agree with you. Your idea is to come up with something that people will agree with you in the future, not now. And I think that's what we got in this strategy right now.
Yeah, it makes sense. So Tavi, thanks so much for your insights. I really appreciate it. My last question is, what is one message you'd like people to take away from our conversation?
Well, to, use your time efficiently, I think. And to, there's like I explained here, I think there's so many ways to successfully spend your time and capital and focus on industries that have been forgotten over the years, that are essential to the functioning of the global economy, and creating partnerships or entering a new industry or learning about new industry like resource companies and so forth is probably something that one, especially a young person, should be considering. I understand that there's a lot of ways to do that. Like I said, becoming an expert of the Brazilian market or the Mexican market, or an Asian economy that is a export commodity driven. There's a lot of ways you can kind of capitalize on those trends, and focusing on that would be, something I wish someone would have told me back in the days. And it's definitely something I'm trying to apply today. And, we'll see if it works. And I'm really excited because I'm a student of history, and I think this is one of the most exciting times of my career. So I'm very glad to be part of this and trying to accomplish so many goals in these industries.
Yeah, I think that's a great message, and I'd agree with that. I think a lot of people, especially young people, maybe take for granted what we have and, and the reliance we have on these commodities. And as you said, it's probably not priced into to how important they are and the potential challenges we'll see in the future. But yeah, thank you so much for your time again. I really appreciate it. So if anyone wanted to find out more about your work and what you do, where would the best place for that be?
Yeah, I have to run Crescat Capital. So we have three different hedge funds, a global macro, long short, and a precious metals fund. We're very focused on commodities, regardless if it is precious metals and electrification metals. And obviously macro is a big thing and for us, and therefore I'm very involved with that, macro trades and ideas and trends and patterns that we like to look at historically and how to capitalize on those. And Lastly, if you're looking for research and other pieces that we put out, you can look at my my Twitter at Tavi Costa, or our website, Crescat.net, is where you can find information about our funds, but also research letters that we put out quite often regarding our macro views.
Perfect. I'll put that on the description below. But thanks again for your time.
Thank you very much.
Thank you so much for listening, and if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.